When you buy a company share, your money becomes part of that business's foundation. It is a specific, measurable stake in a real-world enterprise. Imagine the successful local clothing store. It has a loyal customer base, but the owner needs a large amount of cash to open 5 new branches and buy high-end sewing machines. A bank loan is one option, but it comes with heavy monthly interest payments. For a growing business, that kind of debt is a massive risk because those payments are due even if sales are slow. Instead, the owner chooses to divide the total ownership of the store into exactly 100 equal units. If you buy one of these units, you are providing the cash the business needs in exchange for a 1% ownership stake in the entire company. In the world of finance, we call this single unit of ownership a share or stock. Owning a share gives you a legal claim to a portion of the company's equipment, its inventory, and a slice of every rupee of profit it earns in the future. This creates a balance. The company gets the money it needs to grow without taking on debt, and you get the chance to build wealth as the business becomes more successful. However, it's important to remember that business is unpredictable. Because a company's value can drop just as easily as it can rise, the returns on your investment are never guaranteed. This basic relationship between companies and investors is what makes the market move, but there are other players involved. You have sellers, who are existing owners looking to trade their shares for cash, and brokers, the professionals who help connect the buyers and sellers. All of these people meet in a secure, highly regulated digital marketplace called a stock exchange, which matches buyers and sellers instantly. In India, one of the primary places this happens is the National Stock Exchange, or NSE. Another major platform that connects both investors and businesses is BSE Limited. Today's stock market is essentially a giant electronic bazaar designed to safely connect companies that need capital with people who have money to invest. Large corporations are divided into millions of shares. Buying 10 of 1,000 shares gives you a proportional slice of the business. As the company's market value changes over time, the price of your 10 shares grows or shrinks right along with it. These price movements are driven by real-world performance. If a company invents a popular new product or manages its costs well, more people will want to own its shares, which pushes the price up. Real investing supports the creation of actual goods and services. A company uses your capital to build factories and hire workers, which is how it generates value for you over time. However, if you ignore the business and just chase hot tips or make emotional trades, you are essentially gambling. Legitimate investing requires looking at the facts of the business. To be a successful participant in the market, you have to understand the business you own, rather than just guessing which way a red or green number might move next. We haven't covered the digital lockers used to store shares safely, the inner workings of middlemen, how to read price charts, or the complex contracts used to track the value of other assets. We will save those for later episodes. For today, just keep these 5 points in mind. First, a share is a small, distinct unit of ownership in a real company. Second, companies issue these shares specifically to raise money for growth. Third, investors buy and sell those shares through an open public market. Fourth, exchanges like the NSE and BSE provide the secure digital marketplace where these trades happen. And fifth, share prices rise and fall based on real-world conditions, so your returns are never guaranteed. In the next episode, we will look closer at exactly why companies choose to sell shares and why investors are so eager to buy them. This video is for educational purposes only. Investing in the securities market involves risk. Please read all related documents carefully before investing.